When the economy shifts, it feels like the ground is moving. Market volatility and the sudden threat of job losses make the situation feel uncontrollable. The instinctual response to that pressure is usually to freeze. Investors often panic sell their holdings, stop all financial planning, or spend their days fixating on every new headline. Even those who try to stay active often make a critical mistake. They perform the right financial moves in the wrong order. They might try to pick stocks while carrying heavy credit card debt that's quietly neutralizing any potential gains. History shows that these periods of turbulence actually provide the necessary conditions for building wealth, provided you remain disciplined. Thriving in a downturn isn't a matter of luck. It requires moving away from reactive decisions and following a specific financial sequence. The first phase of this process is purely defensive. You have to establish a safety net before you attempt to grow your capital. That starts with a dedicated emergency fund. You need 3 to 6 months of living expenses kept in an accessible cash account. This buffer ensures that a sudden job loss or an unexpected bill doesn't force you to sell your investments at a loss. Once that cash is set, you have to address high-interest consumer debt, specifically credit card balances. This chart compares the cost of carrying debt against potential market returns. If you are paying 20% interest on a card, every dollar you pay down is a guaranteed 20% return. You won't find that kind of certainty in the stock market. Trying to invest while carrying expensive debt is a mathematical losing game. You have to secure the foundation first. Once the foundation is stable, you can begin moving money back into the market. Market cycles are volatile. To manage this, investors use dollar-cost averaging. You invest a fixed amount at regular intervals, regardless of daily market swings. This approach lowers your average price, automatically reducing the impact of short-term price drops. This works best when paired with diversification. By spreading capital across stocks and government bonds and real estate, you ensure your entire portfolio isn't tied to the fate of a single industry. During times of uncertainty, focus on quality assets. Look for companies with consistent cash flow and a history of surviving previous economic cycles. A consistent, diversified investing strategy helps neutralize volatility. It turns a period of economic fear into a long-term engine for growth. The final phase focuses on increasing your offensive capacity beyond your primary salary. Developing additional income streams, like a side business or freelance work, provides a buffer against layoffs while generating the extra capital needed for aggressive investing. The most effective way to raise your income is by investing in your own skill set. Learning high-demand disciplines like data analysis or project management raises your baseline earning potential, regardless of the economic climate. This increased income allows you to maintain liquidity. When the market is down and others are selling out of necessity, you have the cash required to buy quality assets at lower prices. Expanding your income and skills changes your relationship with a downturn. You move from a position of defense to one where you can actively acquire assets. It is important to remember that economic cycles are a natural part of history. Periods of contraction are temporary, and they eventually pass. As the economy recovers and your earnings rise, you have to watch out for lifestyle inflation. This is the tendency to increase your spending at the same rate your income grows. To preserve what you've built, keep your expenses stable. Direct any new raises or bonuses toward your investments, rather than increasing your cost of living. The sequence is non-negotiable. Establish your cash reserves, eliminate high-interest debt, invest consistently, and then multiply your income. Those who ignore the immediate panic and follow this chronological order end an economic crisis in a more secure financial position than when they started.